Welcome to What Just Happened. 5 quick updates from the markets and economy explained simply so you know what they mean for you and your money. Tariff inflation is here. We just found out that last month, costs of wholesale goods rose more than they have in the past 3 years. In July, the Producer Price Index, or PPI, which measures what businesses pay before products even hit the shelves, jumped 0.9% from June. That's the biggest monthly increase since 2022. So, why do we care? When businesses pay more, they usually pass those costs along to us, meaning higher prices on everything from electronics to packaged foods. Big picture, inflation has been running higher since tariffs went up earlier this year. So, what's going on? There are a few factors at work here. First, many of the tariff deadlines have been delayed multiple times, which has allowed major retailers to stockpile merchandise before the tariffs came into effect. Second, some of the companies have been hesitant to pass on price increases to consumer and have been able to absorb some of the impact of tariffs, since they have just seen huge profit margins over the past few years, though many of those companies are now hinting that they are planning to start passing on those increases to consumers. Another factor that has blunted the effect of the tariffs is that demand has shifted away from countries with higher tariffs, while at the same time, there are a lot of U.S. imports that aren't subject to tariffs. For example, even though Trump imposed higher tariffs on Canada, those tariffs don't apply to goods covered under the U.S.-Mexico-Canada trade agreement. There have been many exemptions made to the tariff rates, and so far, the rise in the overall tariff rate has been less than most economists predicted. But as we see stockpiles dwindle and we head into holiday shopping season, we may see that change. Wholesale prices are just one piece of the inflation puzzle. Housing costs are another, and they have been stubborn. More than half of homes are now selling for less than their asking price, but housing costs are still rising. So, what's going on? In July, 56% of homes sold below their asking price, according to Realtor.com. That suggests sellers are losing leverage because fewer buyers can afford today's high mortgage rates. Normally, we'd expect that to lower overall housing costs. But here's a twist. Shelter costs, the category the Fed uses to track housing and rent, actually rose 0.4% in July, one of the largest monthly increases this year. So, what does this all mean for the real estate market? When homes sell below asking, it shows that buyers are starting to push back. But rising shelter costs show us that affordability isn't improving yet, especially for renters. These mixed signals show how uneven the housing market is right now. Buyers gaining a little leverage, but costs for shelter still climbing. For now, housing remains one of the most stubborn drivers of inflation. For families, this means the housing market may feel cooler if you're selling a home, but not necessarily cheaper if you're buying or renting. While inflation has been mixed, tech stocks have been having a huge summer. After hitting record highs just last week, the market pulled back this week. So, what happened? Tech stocks drove the pullback this week. Big names in artificial intelligence and semiconductors fell in value. And because tech companies make up such a large share of the NASDAQ and the S&P 500, their drops pulled the indices down about 3%. While there's no clear reason for the pullback, investors may have been convinced that tech stocks may be overvalued after a strong summer rally. Also, there's a question if America's seemingly strong economy is showing signs of weakness, as well as whether or not the Fed will cut rates in September. So many investors decided to take profits, cooling the market after last week's record highs. Big picture, markets don't move in a straight line. After record highs, it's normal to see cooling periods where investors take profits or rebalance into other sectors. This doesn't necessarily mean the rally is over, just that expectations are adjusting. We'll see where the market goes in the coming weeks. So markets are cooling off, and it looks like the job market is cooling off too. More Americans applied for unemployment last week, and that could be a sign that the job market is cooling down. Every week, the government tracks how many people file for unemployment benefits for the first time. These are called jobless claims. Basically, people who've just lost their jobs and are asking for temporary financial help while they look for new work. Last week, 235,000 people filed new claims. That's 11,000 more than the week before, and above what economists expected. On top of that, the number of people already receiving unemployment checks, called continuing claims, rose to 1.97 million. That's the highest since 2021. So, why do we care? Jobless claims are one of the earliest warning signs of layoffs, and if more people are applying for unemployment, it means more families suddenly have less income, and that can spill over into the economy because people cut back on spending, and spending fuels the American economy. Big picture, these numbers are still low compared to past recessions, but they've been steadily rising this summer. That suggests that the job market isn't quite as strong as it was a year ago. Fewer job opportunities and slower hiring can eventually affect wages and household budgets. If you're considering a job change or planning a big expense, keep in mind the job market may be getting more competitive. Having a financial cushion and being cautious with new debt can help if hiring slows down further. And that brings us to our last story, the big September question. Will the Fed cut rates? The stock market is betting on an interest rate cut next month, but not everyone at the Fed agrees. Right now, markets are pricing in about a 94% chance of a small rate cut, with some hoping for a bigger one. Why? Well, job growth is slowing and tariffs are driving up costs. Meanwhile, President Trump has been pressuring Fed Chair Jerome Powell to move faster, but Powell says the Fed bases its decisions on data, not politics. So, how does the Fed decide whether or not to cut rates? Every 6 weeks, Fed officials meet and review inflation, job growth, and spending. Their job is to balance two goals, keeping prices stable and keeping employment strong. Rate cuts encourage borrowing and spending. Holding steady keeps inflation in check. So, why do we care about rates? The federal funds rates affects more than banks. It sets the tone for mortgages, credit cards, car loans, and even business borrowing. Lower rates usually mean it's cheaper to borrow, and it can lift stock prices. Higher rates keep borrowing costs up. Big picture, the Fed is split. Some members want cuts to support growth. Others warn inflation isn't under control. Whatever happens in September will ripple through your loans, your savings, and your investments. So if you're waiting for relief, expect a gradual shift, not a dramatic drop. So that's what just happened. Wholesale prices jumped, housing costs kept pressure on inflation, NASDAQ fell off its record high, and employment ticked up, and the Fed September meeting is the one to watch. Don't forget to subscribe, and I'll see you next time on What Just Happened.